Hello, thank you for joining us for this week's Market Carver. I have Zach joining me this week while Adam is out of town. We have some big topics to discuss this week. Going to discuss some of the geopolitical impacts of the stock market. We're going to look at some seasonality again, and then also some big developments that's happening in one of the more defensive sectors. So to get things started, we're going to turn to Zach, who's going to talk to us about how the market reacts to major crises.
Yeah, so the big news this past weekend and then into early this week is the attack in Israel. And so we thought it would be beneficial to talk through market responses to crises in the past and how we're viewing the current crisis we'll find ourselves in. So the chart here is a list of major geopolitical events, many of which are wars dating back to the 40s, down through 2021. And what you'll see, the main thing I want to highlight here, if you see the average lines across the bottom, 1 month out, 3 months out, 6, 12 months, etc., there are not typically large moves either to the upside or the downside over the long term in response to these crises. I think the knee-jerk reaction can be to assume that a geopolitial event like the one that we've seen this past weekend is going to result in a protracted down market. It could be very detrimental. But what we see most times is that the moves are not that dramatic, especially when you look multiple months out. The market tends to respond with relative ease. A lot of that is because there are other things going on in the markets rather than just the geopolitical event. So there are oftentimes what you'll see is a knee-jerk reaction at the very beginning. For instance, what we've seen throughout the beginning of this week, defense stocks are up early this week. The energy markets are up, particularly oil and natural gas. We've seen some travel stocks decline a bit, think airlines, cruise lines. But overall, there are other things happening in the market that will impact market performance, especially when you look multiple months out, one of which Andrew's going to cover here in a minute. And so as we look at the things that are happening in Israel, it is something that we will continue as an allocation team to monitor going forward, the residual impact, how it could impact the market, particular sectors of the market. But our overall strategy does not change. What we'll look to do is continue to try and find opportunities where we believe mispricing has occurred, sometimes in response to knee-jerk reactions that happen after geopolitical events. We'll continue to look for those mispricing opportunities to invest and to potentially make money. But our overall strategy will not change despite what is going on in Israel. So with that, I will kick it over to Andrew.
All right, thanks, Zach. Now we're going to turn to a topic that we've been discussing quite a bit on this Market Carver for the last several months now. We started talking about this, I believe, in early August, and that's talking about market seasonality. It's important to remember this isn't necessarily part of our risk barometer, what really dials up and dials down our tolerance to risk and investment in different parts of the equity market, but it is something that we pay a lot of attention to, especially when the market is really responding pretty closely to how these seasonal patterns have played out. Now, just to start kind of from the beginning, historically, when we look at pre-election years like we're in now, we typically see the market peak around early August and begin a decline for 2 months. September, as we've discussed several times, has been a fairly rough month for the market. And that's how we've seen this play out for the S&P 500 this year. Now we're starting to move into more of the positive part of seasonality, which we're thankful to be able to share with you. As this chart shows that's on the screen right now, these are all the pre-election years. And then in black is our current year, which says we are here. That's where we are right now as of the end of last week. And what we see as a common pattern is typically around the first part of October is when a lot of these pre-election years start to turn higher. You can see from the black arrows that a lot of them start to bottom after that 2-month decline and start to have varying degrees of an up move into year end. And so this upward bias in the seasonality from it becoming a headwind to now a tailwind, meaning that it should help give a bolster to equities if we continue to follow this pattern. Now, this isn't something that we obviously are going to follow blindly, but it is something we want to be cognizant to, recognizing that equities in pre-election years typically do have a stronger back half to the year after having a little bit more volatile August and September like we had this year. And so as we are starting out this week, we did see a potential low last week as equities now are starting to rally. We've held some key moving averages on the daily charts that we're looking at as for solid levels of support, which we're very encouraged by. And now equities are starting to find maybe some semblance of buying pressure coming back into things, which we're, of course, encouraged to see. Now, the last point I want to talk about is something that is a little bit different, and it's looking at a long-term chart of actually just one specific sector. Now, this year, the market's really been driven by a lot of technology stocks. We've talked a lot about that on the Market Carver, how it's just a handful of tech stocks have really been able to drive the market higher. A lot of the more defensive sectors, utilities, healthcare, consumer staples, have not been able to hold up as well. In fact, when we look at just consumer staples, a lot of the stocks below the hood of that sector are actually in very severe downturns. So the chart I'm sharing today is looking at how many stocks in the consumer staples sector are above or below their 200-day moving average. That's one way we can define whether a stock is in an uptrend or a downtrend, whether it's above that long-term average. And what we find is as of last week, we have less than 8% of this sector are actually trading above their long-term average. Going back in history of the last 15 years, really there's only been two other times where we've seen this low level of upside participation from the consumer staple sector. It was during the COVID crash during 2020 when the world stopped, and the great financial crisis back in 2008. So what's important to recognize here when we look specifically at that '08 instance is just because we saw less than 8% of stocks above the 200-day moving average wasn't necessarily a sign that we were at a critical low and it was a great time to start looking for opportunity in this sector. It was when we started seeing improvement from that level, when we started seeing it go from 6, 7, 8 up to 10, 12, 15, we start seeing those sectors improve, has created opportunity in this space. So this is something we're looking at and saying, okay, there's a lot of stocks that maybe are undervalued. They've been thrown out with the bathwater, so to speak, and there might be opportunity in some of these names. And so it's something we are paying attention to because this part of the market, while we are seeing strength in other parts like technology and communications and energy, consumer staples very much is being sold off. So we're looking at maybe if there's any opportunities there that we can take advantage of in the near future. But it's very interesting to see such a stark contrast in the market to where you have a sector that's doing so poorly of its individual stocks. Meanwhile, you have other sectors that are doing extremely well in a market that is up high single digits, double digits at varying points in the year. So we thank you for joining us. We know this is a very important week. There's a lot of headlines, a lot of news to digest. We appreciate your trust in our team and our advisors and our asset allocation, and that we're here to serve you. As always, if you do have questions, we're happy to discuss that, talk with your advisor and talk with our team. You can call the number on your screen there or scan that QR code, and we're always here and available. Thank you, and we hope you have a great week.